the S&P 500 has done something over the last 24 trading days that we haven't seen since 2022. We're going to go over exactly what this is and review some other charts as we prepare for September 2024. So let's get into this. So the first question is, what is so special about the last 24 days and why did we choose this time frame? Well, as usual, it's always market driven because 24 days ago was July 31st, 2024. Market gained 1.6% and just a really strong finish to a month that started well and didn't finish too well, of course, because technology started to really show some cracks, especially in the second half of the month. So that good feeling we had coming out of July, of course, was squashed as soon as August began, where we had those 3 straight 1% declines. And as we can tell, overall, all the way through yesterday, Tuesday, September 3rd, there were just a lot of 1% moves. And viewers know we talk about this a lot because it just gives us a good indication of volatility both up and down. So this amounted to 50% of the time, 12 absolute 1% moves over the last 24 days, 8 up, 4 down. But again, we look at this in totality. If there's a high frequency on both sides of the tape, it just means it's a very tricky trading environment, and we have to be cognizant of that. Now that compares to 2022 for the year, 128 moves, 63 up, 65 down in 252 trading sessions. That's 51% of the time. So 50 compared to 51, same type of action, a lot of sharp moves and acute turns. So we know this is not apples to apples. One measures 1 year, one measures 1 month, but we understand that if this continues, what it could develop into. 2022 is fresh in everyone's memories. Now, this is, of course, what it looks like over the last 24 days, and we get an even better picture compared to what happened prior to that, where this is where we started it from, the 31st of July. Things started to change, as we know, in the second half of July, but really much, much different compared to what we saw from after the April low all the way through the end of June, where we went over 50 days without a 1% decline, and over that time frame, only 3 1% gains. And along that way, no surprises, what did we have? Pretty trustworthy and consistent uptrend. Right now, the S&P is trying to get back to that, but it's going to have a difficult time if this continues. And so another way of looking at this, just month to month. We've shown this before. We've eliminated 2023 because we want to show really how distinct the difference has been in 2024 versus 2022 up until August. And so far, 1 month with 10 1% moves, 7 1% gains last month, 3 1% losses. That compared to 8 different months of at least 10 1% absolute moves in 2022, with the least amount being 8 in that bear market rally in August. And so on average, as we can tell here, between 10 and 11, that just made it hard for both sides, right? Bear markets cut both ways because volatility appears on both sides of the tape. So the question is, did August now put volatility back into the marketplace, and will it stay with us for quite some time as we enter the typically volatile periods, September and October, again, with the election in front of us, with the first rate cut happening in a few weeks, with technology now having a lot of trouble. So let's zoom out and look at this weekly chart. Now, this is the S&P 500. Once again, this is a line chart using log scale. So this only measures the weekly closes, right? It doesn't have all of the extreme intraday highs and lows on it. So one way to look at it. And if you look at it this way, we know that the S&P had a new closing weekly high and monthly high last week as August ended. Very similar to what happened at the end of 2021, where we continued to see higher highs toward the end of that year. But then momentum started to slip. Even though the S&P 14-week RSI did get overbought again, as we can tell, it was a negative divergence making a lower high. It's even more visible now with the most recent rally failing to produce an overbought reading on a weekly basis. That is, gives us a much more distinct negative divergence. Now, as we know, negative divergences like this are warning signs. Sometimes they play out, sometimes they don't. But when this type of thing happens, and we haven't seen it in about 2 years, it makes us at least pay attention to what's going on, right? So we have to keep that in the back of our mind as things progress. And so, of course, the VIX. And as we know, on Tuesday, the VIX was up over 30%, just a huge move, only the second time that we've had a 30% day going back to November 2021. As we probably know, the other time was August 5th, right? Just about a month ago. So that's a tight cluster. Now, overall, we know that August 5th happened. We walked into that morning and the VIX was up about 100% and came off that time frame. So it actually closed the week lower. So one chart we're showing our clients back then were all the 40% weeks that the VIX endured going back 10 years. And one thing that was notable was that you typically don't have a lot of back-to-back 40% weeks. The following week is usually a lot calmer, as we can tell here. But, and it's a big but, when 40% weeks pop up, it typically is not in a vacuum. You can see this more clearly by highlighting the instances when they occurred in clusters, right? 2015 into 2016, right? 2018, 3 different times during the vol implosion, and then the fourth quarter later that year. 2020, COVID in the period that followed, and then, as we know, at the end of 2021, early 2022. So once more, we asked the question, did the most recent spike in volatility from last month and again yesterday, is that enough? Is that just going to shake things up and get us back on track? Or is it an indication that things now are going to be materially more difficult from a price action perspective, from a pattern perspective, as we get into these months? With the third question being, if we do see more volatility, can the S&P 500 take a punch like it has before to be able to then take advantage of the typical fourth quarter positive seasonality? So speaking of patterns, as we know, still waiting for something like this to play out, where the move from the August low was so severe that we thought potentially that the trading range that appeared in the second part of August could eventually lead to a breakout, because it looked like a potential inverse head and shoulders pattern. Seen numerous bullish patterns work. There's been 9 of them so far that have worked since the beginning stages of this comeback. The biggest ones being these two when we saw the breakout in late November, early December, and again in May. They share the characteristics of having those breakouts be clean. Again, not a lot of whipsaws when you have low two-way volatility, and that helps them become successful. In other words, achieve their upside targets. Still waiting for that to happen right now. So in essence, we have a neutral stance on the market until we have another short-term objective with us once more. And so the silver lining, of course, in all of this is that the S&P 500's biggest bullish pattern breakout continues to be in play. This has been going on since mid-January, the target of 6,100. The S&P started today about 10% away from it, but still further above the breakout zone. And so because of the ability to take advantage of that breakout in January, the S&P has done a very good job of being able to absorb the volatility that we saw from March to April and again from July to August. So the point being here is that if the volatility does stick with us for longer than we've seen so far, regardless of the reasons, the hope is that the S&P can once again take that punch of volatility, regroup, keep the 6,100 target in play, and then we'll see additional bullish patterns form, which could potentially take us into the fourth quarter. That's it for today. Don't forget to check out these videos and subscribe, and talk to you next time. Thank you.